guys, this is Middleman K. Thanks for checking out this video. It'd mean a lot to me if you could please like this video and share your thoughts by leaving a comment. And if you enjoy this type of content, please subscribe to the channel. Today, I want to talk about credit cards and how to leverage and maximize its benefits to essentially get rewarded each time you transact using the card. First of all, this must be mentioned, but I'm not a financial advisor in any way, and nor is this video of any financial advice, and I must mention that also applies to all of my other videos as per what it says in the description, the disclaimer. So please make sure you do your own research and speak to a financial advisor before you consider taking up this strategy. So credit cards, it's a common thing that everyone almost has in their wallet day to day, but there's many things that you should be aware of them. So let's start by understanding what a credit card is in a traditional sense. This is a page from Investopedia. What is a credit card? A credit card is a thin rectangular piece of plastic or metal issued by a bank or financial services company that allows cardholders to borrow funds with which to pay for goods and services with merchants that accept the cards for payment. Credit card imposes the condition that cardholders pay back the borrowed money plus any applicable interest, as well as agreed upon charges, either in full by the billing date or over time. That's a pretty good example of what a credit card is indeed, and some key words that we have to be mindful of. They're such as borrow, interest, additional agreed upon charges. Some of the ones that caught my attention, if you ask me. So now let's take a look at a pros and cons of a credit card. What is it for? What is it good for, and what are the downsides to it? This is only some of the pros and cons. The whole list could go on much longer depending on how deep you want to go, but I think these are the key things. Now, I may have actually missed out on one or two things, so I'll just freestyle this as I go along. So first of all, the pros, the benefits. You'll have loan, pretty much cash at your disposal. What you're able to do with this is, credit cards, is that where a merchant or a service takes a credit card, and it may be for something that you have to pay that was unexpected, which without a credit card you otherwise would have to use your savings. And in order for you to be able to prevent yourself from digging into your savings that's normally accruing some kind of interest, may be little, but what you're able to do with a credit card is you're able to use that as a substitute of the savings that you maybe would have to dig in otherwise, to be able to cover yourself as long as you pay the agreed amount back within the duration that you must before you start accruing interest or other charges that you want to avoid. Another pro when it comes to credit card, and this is dependent on the type, is the interest-free period that it can come with, which I'll touch on shortly. You could also get rewarded for using your card, which is one of the biggest benefits side by side with the interest-free period. The cons is the interest. So whether it's after the interest-free period or the type of credit card you use may not have a interest-free period at all. That means from the day that you make any transactions or purchases using your credit card, and from the following day, if there's any amount outstanding, you'll start to accrue interest on that. Debt burden. This really comes down to money management, just knowing how much money is coming in, how much money is going out. And if you obviously overspend on your credit card and it's more, obviously that repayment that you have to make is more than what you're able to afford or what you're able to deal with, then that could become a debt burden if you don't know exactly what you're in for before you swipe that card. Credit history impacted. So this can happen when you apply for too many cards or too often. This could also happen in a case of any loan as well. So there's a thing called a credit history against everyone's pretty much financial profile, you could say. And against that, there's our credit records. If you've been paying your bills on time, if you've been late for a mortgage, if you've been late for a credit card payment, things like that. And that history of it can simply be affected by applying for too many cards. So a good idea is to try not to apply for a loan or even a credit card soon after you get the rejection until you find out why you were rejected. Because if you just blindly apply so many times, you'll pretty much be blacklisted, so to speak, for a period of time, which goes on your record, and it's not really good if you ever need to take out some kind of a loan, or even if you wanted to apply for a credit card in some instances. It'll pretty much reduce your chances of being a successful applicant. So these are just some of the cons that I wanted to highlight, and if others come to mind later on, I will touch on that. But let's now take a look at a couple of cards that I've got myself that I use personally. And this isn't any recommendations or anything, this is just me sharing with you my perspective on what I find useful and how I go by my finances. One of the cards that I use is the Kohl's MasterCard no annual fee credit card. This card has got many perks, but a few things that really stood out to me first of all was the $0 annual fee. Some cards that you apply for, credit cards, they come with a lot of incentive and perks that they'll charge you an annual fee for the card that you take out, whereas this one, it's got $0. Next thing that really caught my attention was the interest-free days. So what this means is you pretty much have a interest-free period where you're not charged any interest on your transaction up to 55 calendar days, which is pretty much 9 weeks. So within the space of 9 weeks, let's say you might have used your credit card once and you've got $100 bill owing on it. As long as you're able to meet the minimum monthly repayment and also pay off that $100 within that 55-day period, then you won't be charged a dime of interest. But if you don't repay all your interest, all your required amount, the money that you've pretty much essentially borrowed in advance using your credit card and spent it on credit, if you don't pay that back in time, you will be charged whatever the daily or the monthly amount is based on this 19.99 per annum interest rate. Another thing that I found quite cool about this credit card is the Flybuys point system that you've got. So when you go and purchase anything that's eligible spend under the Flybuys program, for every $2 that you spend, you get a point back on it. And the Flybuys card ID and the barcode is also a part of the credit card as well. So if you're places where they do accept Flybuys, I find that it's very convenient to be able to tap the barcode, register whatever I'm about to purchase, and then buy or pay for whatever it is, or the service or the product that I am about to purchase. So that's extremely helpful. If I was to scroll down on this page, there are more features. There's more rates and fees, and rents and fees are very, very important. You obviously don't want to use your card, if possible, the credit card that is, to get a cash advance or use that card to make any withdrawals of cash, because you'll be pinged with quite a heavy fee or interest or some kind of fee to go with your request, because you're pretty much taking out cash on something that's a credit and you're getting that available instantaneously. So there is a service fee to go with that, often hefty. And this page goes into full details. And again, this is just one of the examples that I wanted to share with you. The second example that I have is the Amex, American Express, Qantas points, Qantas Express or Discovery card. I think that's what it says. So this is also another interesting card for the similar reasons. So first of all, annual fee, $0 per annum. The interest-free period is up to 44 calendar days. And the interest rate is 20.74 per annum, so just a little bit higher than the Kohl's one that we just looked at. And again, this is an American Express card. This also comes with point system as well, and because it's an American Express, if you fly out for the Qantas frequent flyer, which you're actually able to do free of charge, and I'll find out, if I can find that link, I'll link it in the description for you. And what you're able to do is, if you were to otherwise sign up with other links that are out there, it may cost you $89 for a lifetime membership, but there are actually links out there for Qantas Frequent Flyer that's free to sign up. And if you've got that membership number before you apply for this American Express card, then the card company could associate your Qantas Frequent Flyer account with your American Express card. So whenever you spend or make purchases using your American Express Amex card, you can earn around 0.75 Qantas points for every dollar spent on purchases. There are some conditions to go with that, exceptions. So there's some things that you won't get as many points. For example, if you spend it at government bodies in Australia and things, and you can earn a little bit more if you were to shop at through Qantas and things like that. So it's a very Qantas centric card, but there's benefits to go with it. Even if you don't shop necessarily through Qantas, even if you just wanted to make your everyday purchases, you can do so through, using this card, similar to the MasterCard that we just looked at from Coles. Now, you might be asking yourself, why is it that I have two different sets of cards? There's two reasons. So one of the, or two main reasons, sorry. So one of the reasons is that American Express isn't always accepted at all merchants. In fact, it's probably one of the more rare ones to find, and Visa and MasterCard seems like the mostly widely accepted cards. So for that reason, I like to have both of them on hand, because both of these reward systems through Coles and also the Qantas frequent flyer can give me different rewards at different times. But essentially, I'll always have a credit card at hand that whenever I choose to use that, I can pretty much make points or earn something from it. There's an incentive to go with every dollar that I spend each and every time. So where American Express may not be accepted, I'll use the Coles card. Where the American Express is accepted, I'll use the American Express card, and so forth. So I always alternate between the two, and that's one of the reasons. Now, secondary reason is due to the fact that if in a case of emergency, if I don't, again, want to use any liquid available liquid savings, then as long as the amount isn't big enough, and as long as I know and am confident that I can pay back whatever the amount that I borrow within the interest-free period. So on this card of the Amex, it's up to 44 days. And as for the Coles, it was for up to 55 days. So you pretty much have a minimum of 7 weeks to be able to repay whatever the amount that you borrow / use on that credit card. So that means I have a larger pool of funds available should I need to use both or either of the cards in any emergency situations. So it's pretty much a loan and cash at my disposal as per the pros and cons table that I highlighted before. So it just means that, yes, I've got my savings on the side, but yes, I also have extra buffer credit that's available to me to use at any time that I need to. And I use that to my advantage a lot, because actually this is another one of the pros that we can certainly add. So this is only really a pro if you've got your money management down pat, and it's extremely important that you've got your finances and you know the inflows and outflows on the back of your hands. Or otherwise you can lose track of your accruing of the debt and the interest on your credit cards quite easily, and it could become a nightmare when it shouldn't have to be. So the way that I like to use credit cards to my advantage is knowing that the moment I spend my savings on something unexpected and getting a dent in my bank account, and from that savings that I use, getting lesser interest or lesser return on leaving that money out of bank or wherever it may be sitting, making some kind of a return. If I take that money out of that pool, it means that I'll be getting less of that, back in return, or whatever my expected return was over that period of time. Whereas if I was to use my credit cards up to 55-day interest-free, or up to the 44-day interest-free one, either or, so again, minimum 7 weeks and up to about 9 weeks, what I'm able to essentially do is buy time of 7 to 9 weeks without that impacting me or my other savings or my other investments that I have to decide. So that means I can still let my investment vehicles run and let it still do what its intended purpose is, which is to pretty much sit there and accumulate and compound the interest that I allowed it to assign it for. And what I'm able to do is, with the time of 7 to 9 weeks that I've got, pretty much pay for what I need to. That might have been an emergency then and there using my one of the credit cards. And over that space of next 7 to 9 weeks, depending on the card that I use, I'll then also look to allocating more of what would normally have been my savings into repaying the funds that I borrowed using the cards. to make sure that that loan is repaid before the interest-free period is over and interest start kicking in. So on both of the cards, I actually don't think I've ever paid a fee, like an interest rate or any late fee or anything like that at all, because I never over leverage my credit cards, and I really only use it within the boundaries that I feel comfortable in using it. Sometimes if I'm a little short on cash, but I just wanted to have a little bit of disposable cash, actual cash in my debit card on hand if I'm going to go somewhere, then I would tend to use my credit card just to get me by if I have to, so that again, in case of emergency, I still have cash to be able to withdraw without that impacting me. If I would have had to do that, let's say using a credit card, and I would just simply use my credit card when I'm out and about, or if I have to again make any necessary purchases, and keep sometimes that cash in my bank account, so that again I won't have to rely on a credit card to perhaps make some emergency withdrawals and things like that. So that's just some ideas to float out there for you. Now, the next thing that I wanted to touch on is to put all of your savings of the points that you've accrued into perspective. With the Coles credit card, if you were to use $1,000, the earning rate is you get 1 point of flybys per $2 spent on eligible spend, which will give you 500 points, flyby points for every $1,000 spent, and for every 2,000 flyby points that you accrue, you get credited $10 called gift card on your credit card. So whenever you swipe your flybys barcode at the checkout, you're then able to claim that $10 gift voucher, which is pretty cool, especially if you shop a lot at Coles and you're already going there frequently. I would think that this is extremely useful because I fall into that basket of category. I leverage this myself. The Amex credit card, so let's say if the spend was similar at $1,000, you'll get, if I was to average out, because there's different earning structure as we saw on the Amex page before, you'll earn 0.625 Qantas frequent fly point for $1 eligible spend, which will give us 625 points. And the reward example here for Amex, which what I like to use is for Woolworths gift card or even a petrol voucher. Sometimes at Caltex, they've got it for that. Petrol one is extremely useful. So once you accrue 9,910 points, you'll be pretty much rewarded for a $50 Woolworths gift voucher. So what you're able to see between the two, the earning rate is pretty much on par. This one's probably about 20% quicker, but where you're able to spend Amex is a little limited, and also the interest-free period is a little bit short as well. So, but again, if you use the two interchangeably, you're bound to pretty much accrue something at the end of the day, and what you'll accrue will only be to your benefit and not to your detriment, as long as you pay off everything within the billing period before your interest-free is over and the interest does start kicking in. So that's what I wanted to share with you guys today around the credit cards and how you're able to use that to your advantage, as long as you've got your, again, money management down pat, and you just have a very good grip of your money, the ins and outs of it. Or otherwise, I personally wouldn't even consider taking up a credit card, because there's so many news and things like that you hear, and I'm sure you know yourselves from people around you, or maybe even personally, that credit cards can become a true nightmare because it can be a black hole of spending. So I hope you found this video useful, and I hope you did learn something new today, guys. That brings us to the end of the video today. So if you've got any thoughts, please share them down below. If there's anything in particular I might like to learn, please also let me know down below. Thank you for watching, and hope to catch you soon. Bye for now.